Hello, my name is Josh, and this is Finance Soup. And today I want to discuss Lemonade. For those who don't know, Lemonade is a tech-first insurance company, and I want to use them as an example of why it's important to understand the industry of the business you're analyzing, and how you can't use a one-size-fits-all kind of way to analyze companies. I previously mentioned how different companies have different exit multiples. So, different companies, their earnings are priced differently based on the industry they're in. And Lemonade is a similar example of why it's really important to deeply understand the company and why you have to look at the details. Um, so first, let's just talk about the company. Lemonade offers insurance. They started with just renters insurance, but now they're offering home insurance, pet insurance, life insurance, and they're even going to offer car insurance. It's all done through an app, and they use an AI to both measure your risk, to sell you the insurance policy, as well as to process claims. And they say that all the data they collect enables them to improve their risk adjustment. To me, well, not to me. Insurance is all about pricing risk. What is the risk of something happening? And so, if you think, what is the odds Josh gets in a car crash? You have to properly understand those odds so that you can offer me insurance and coverage at a rate that, if you take 100 Joshes and you think there's a 50% chance that, we get in, or 1% chance we get in a crash, and there's 100, odds are one will, so you have to collect enough in premiums from everyone to cover the cost of that one person, and then also money left over to have a profit. So again, it's about properly pricing insurance. This is why companies like Tesla think they can offer insurance. Tesla's now offering insurance because they have so much more data on the cars, the way you drive, so they can better price your risk in your insurance. So again, to me, insurance is all about data because you're trying to understand the risk. In fact, the original insurance company, I think it was a monastery because priests were dying or something like that, and their families were not priests, it was preachers or something, and their families were had no money, so everyone would pay into the insurance company, and someone analyzed the likelihood of someone dying, and that's how they determined, you know, how everyone was paid out. So someone had to collect all this data on when people died, how many years they lived on average, stuff like that. So that was the original data, and now we obviously have much more complex data. Are you a smoker? That's going to lower your odds of living long. Same with like cars again. Cars an obvious one. How do you drive? That's a huge risk factor. Some people even say like obviously the cost of the car is important, but like if you're driving a sports car, maybe you're driving faster. There's actually even an urban legend. My wife told me this, but she was mistaken that red cars have higher insurance premiums than other colored cars. It's not true, but I think it's an interesting idea that it kind of does make sense that, I would bet red cars probably correlate to faster driving and more um, wildness, which will theoretically result in worse outcomes for the car and higher risk of crash. Again, back to Lemonade. So they're an insurance company. They use AI. Another thing they do differently, which I think is really important, is most insurance companies, the less they pay out, the better for them. Because if they don't pay out a premium, that's more profit they can keep. Again, they take in all these premiums. You pay a premium for your policy, and anything they don't pay out, they keep as profit. So they're incentivized to not pay out. That's why people often hate insurance companies. They have a low NPS score, which is Net Promoter Score, which is basically a proxy for how much people enjoy working with them and think of the company. And there's horror stories about people not getting paid out and needing this for health insurance. I live in Canada, so don't have that problem, but you hear about them from the States. That's I would say that's what Breaking Bad was, but he didn't have proper health insurance, so he had to sell meth. So um, yeah, get a little distracted. Um, but what Lemonade does differently is they take 25% of your premium no matter what, and they set that aside, and the other 75% is used to cover premiums. So if you have premium, that's used to cover that. And if you don't claim a premium, they actually donate some of that towards a charity of your choice. So to me, this is a very smart business model because you understand they are not incentivized to not process your claim because they're not making any more or less based on processing your claim. Unlike another company whose incentive is to not process your claim. For them, if they don't process your claim, there's no advantage or disadvantage because again, they've already set the money aside to cover claims and they can't take any more profit than 25. They're capped out. And it's also incentivizing you to not make false claims. So I think it reduces fraud, which is a big cost to insurance companies and a real risk. Like, let's be honest, like, yes, they don't want to pay out because they make money, but also they don't want to pay out if it's fraud. Um, so the logic is if you know that you're kind of taking away from charity if you claim, like, if you don't make this claim, it goes to charity. So people would theoretically less likely on the margins to commit fraud if they knew it was otherwise going to go to charity. So, or even exaggerate the claim. So I think that's a really smart business move. So again, I really like the company. I think, and it shows. They have a huge NPS score. I actually wonder if in the shareholder letter it shows the NPS score. Let's look, NPS. No. But they even note in their prospectus, which is when you go public, how high an NPS score they have. Big believe in this company, and again, it shows. Actually, let's do this. Lemonade Insurance app. You can see how many they have. 4.9 rating on 51,000 reviews on the Apple App Store. So again, it's very well regarded, and people seem to really like working with Lemonade. Not currently available in Canada, otherwise I would switch. So I'm not a user. So again, looking at my, my three factors. One is product. Do I understand it? This one's actually a little more complex because it is insurance. I do understand insurance. I understand risk, but wading into the details took a little more time. I'm not a user of their insurance, but I do understand insurance. I've had to get quotes. It's a pain in the ass, so I can understand how going on your phone and getting a quote in 90 seconds would be really a huge time saver. The second one is kind of macro trends. So let's touch more on Lemonade. One thing I found interesting was they actually mentioned that most of their clients, here, hold on, Lemonade under 35, 75% of theirs are under 35. Under the age of 35. So this is huge because this is a growing demographic. People my age and younger, there's more and more of these people. They're mobile first. They want to interact with a phone to get their quote. They don't want to call someone. They don't want to wait on hold. They don't want to have to work with an agent. So they're really capturing this new renter, the younger demographic. And another thing I thought they found interesting, actually, I wonder if it's here, 90%. No, okay. Lemonade, switching. I might not find it, but they said something like, typically with insurance companies, it's people switching. Oh, I went from Geico to here. And so that's where they get most of their new customers. Lemonade, I think they said 90%, I could be off, but 90% of theirs were not switching, they were new to insurance. So again, they're getting young people who've never had insurance before, and now they're getting, they're renting an apartment, then they're getting a house. And they talked about how that improves their premium. So again, what's a premium? Premium is the money you pay to cover your cost. So you can see premiums per customer was up 29%. So they're making more per customer. Each customer spending more. They used to spend 190, and they said that makes sense because typically they only had renters, and as these renters age, they get more money, and therefore they, have more things to spend. It used to be 75% of their premiums were on renters, and now it's 56% on renters, which are by far the lowest insurance premiums. Now it's 30% homeowners, 13% pet, 1% life. These are brand new products, pet and life, that they just started, so that is reasonable. And they're saying as time goes on, you'll see homeowners will make up a bigger piece of the pie, as will life. But also, the money spent per customer will also go up because even if maybe they'll have multiple things. They won't just be renters. They'll be renters and pet. They'll be homeowners and life. As you age, you typically take on more insurance because you want to cover your risks. And I have a little thing here. These are just very rough estimates. These are just back of the envelope, not based on anything, but you know, life insurance, pet insurance, car insurance, home insurance, just to give like a reasonable assessment. Home insurance can be anywhere from 750 to thousands of dollars. Depends how expensive your house is, right? Depends, are you insuring a house that's 100,000 in Michigan or a $3 million house in San Francisco. But renter's insurance is almost always the lowest. So I think there's a huge driver of growth is the fact that they are moving from low revenue items or low premium items to higher premium items and layering these on. Um, so this is really good for their business, getting this mix of, and that's ignoring how much customers actually grew. So when we actually look at customer growth, customers grew 48% year over year, the total number of customers. The enforced premium is the total number of customers they have times the premium per customer. So this is basically, this isn't really their revenue, this is enforced premiums. The reason why I say it's not revenue, and this is why it's really important to understand the industry you're analyzing. So let's go to Lemonade's revenue. Here we have, you can see it's revenue, and you can see here, you know, they're talking about these massive growth numbers. Look at how much it grew, and yet when you look at revenue, it went up, and then suddenly it dropped a huge amount, massive amount, and it's slowly growing back. Why is this, and how could this be if you're seeing these huge growth? Well, the reason is they actually did something different. Instead of typically an insurance company will take in all the premiums and will take on all that risk. So if if there's a terrible weather event, suddenly they'll have to pay out a lot of money. Lemonade's a small company; they're not currently profitable, and so because of that, they actually have to offload some of that risk. So they use what's called a reinsurance company. It's an insurance company for insurance companies. So they sell 75% of the risk. So that's these premiums. They give 75% of the premiums to another company and say, you have to cover 75% of the claims. So if there's a claim on that amount, you have to cover it, not us. So they only take on 25% of that risk. That lowers their risk profile. So, if there's a terrible weather event, like happened with the hurricane, and we actually can see here, let's see if we can find it. Oh, here, gross loss ratio. So this is the percentage they had to pay out. So this is 74% is paid out. They want this number low because they want to say, hey, we're doing a good job of analyzing risk. They don't want it, if it's 110 or something, it means they're paying out more than they bring in. You can see this big spike there. That was actually because of, I think, the Texas freeze, that's what it was. So that led to a massive spike, and potentially, if they were taking on all that risk, they would have had to pay out money they don't have on hand. But because they offloaded some of that risk to a reinsurance company, they only were responsible for 25% of the claims. So that gives them a better capital structure. So they have to have less money on hand because, again, as an insurance company, you have to keep money on hand in case there's a risk. And they don't want to have to keep a lot of money on hand. They want to be spending that money on marketing and growth. So because you can only count the premium you cover as revenue, not the 75% they gave away, that's why their revenue dropped significantly because they switched their business cycle or their business model from keeping 100% of revenue to only keeping 75%. So again, this is why it's really important to deeply understand what's going on. This is a complex one. Let's actually see if it even talks about reinsurance. Reinsurance. A year ago, we transitioned to a quota. We agreed to cede, that means give away 75% of our premiums to a panel of partners, thus retaining 25% of the risk on our balance sheet. Again, that's exactly what I talked about, and this is why it's really important. They actually talk about how they're going down from 75, they're slowly going to do 70, and they're going to keep going down. So they want to take on more of that risk because as their AI gets better, and this gross loss ratio, which again is an understanding of kind of their risk, how they're doing analyzing risk, as that goes down, they're okay taking on more because they have more of a buffer. As you have less margin, there's less margin for error. So as they have more margin and a better gross loss ratio, they're able to take on more of that risk and the upside. So again, there's a lot of moving parts here. You have to understand the insurance industry, the business. Again, macro, I think there's lots of tailwinds from demographics. I think young people are aging into this, and I think there's also a lot of talks about a transfer of wealth from from baby boomers who are aging and potentially, I mean, they're eventually going to die. We all die. Again, sorry to bring this down, but yeah, that's just me. To the younger generation. So, parents are passing on wealth to this generation, and people in this demographic are going to use that money to buy houses and they're going to start having kids and stuff. And that means they're going to need more insurance to cover their property, their life, their cars. So I do think these are definite positive tailwinds. So in terms of valuation, I did a bit differently because, as I said, you can't use a one size fits all. And this is a very different business. So first I had to understand the insurance business. So, typically insurance companies trade at a lower PE and they have lower margins. So I used conservative estimates, 10 PE. Maybe you want to go higher because they're a tech company and they have some advantages. And maybe same with margin. You could say they um, could get 15%. Again, right now they're not profitable, so they don't have that, but let's just use these very conservative estimates, 10 PE, 10% margin. And I said I want to get a 10% return on investment. That's basically a discount rate. So typically I use an 8% discount rate. Here I'm using a higher one because there's risk here. You have to really understand the business and all this. So if you do 1.1 to the power of 10, you get 2.6. So basically I'm saying in 10 years, I want the market cap to be 2.6 times higher. So what's the current market cap? It's about 4 billion. So we need the market cap in 2030 or 2031 to be about 10.6 billion. And if you have a 10 PE and a 10% margin, then you basically need premiums, assuming they get rid of all the, I'm assuming they don't do this reinsurance forever. I'm assuming they use it while they scale up. You need premiums then to be about 10.63 billion as well. So again, it's basically 10% margin, 10% PE. So 10 times 0.10 or 10% equals 1. So you want these to be the same. Again, you could change this and you could say, okay, we want a 15 PE and 15% margin. So that would lower it, but we're trying to take conservative estimates here. So how do you get to 10.6 billion in market cap, and is that realistic? So first, the insurance industry is massive. It's currently $5 trillion. And even if you use a very conservative estimate of the growth of insurance, you're looking at $8 trillion. So you're looking at a tiny percentage. Like if they need to get to 10 billion, you're talking, what is this? You're talking 0.11%. The largest insurance company currently by premiums is 200 billion. So and again, conservative estimate, you assume they grow at 5% per year for the next 10 years. You're looking at them being about 300 billion in premiums. So Lemonade just has to be 3% as large as the largest insurance company. So you're not talking, this is a gut check. This is saying, hey, they have to grow a lot. They have to grow 30 times larger. That's the difference between their current premiums, which are 350. Their full year projected are 350 million. Currently, they're at 297, and where they have to be, which is uh, to get to 10 billion. They need to grow 30-fold. But even growing 30-fold, they would only need to be a very small player in the insurance industry, which is huge. So that passes the gut check. Sometimes I see a company and it's like, oh yeah, all we need to do is grow this large. I'm like, well, you'd be larger than, the entire industry in 5 years if that was the case. So there still would be a very small player. So these seem like reasonable assumptions to get to. But what are we looking at in terms of how they get there? Well, I looked at a couple things. So one, we talked about how the insurance premiums are currently at what is it at? It's at 246 per person. As they take on life, car, pet, and higher end homes, as well as inflation in these products, I said, could this get up to 750 per person? I think it could even be higher, but again, I want to be conservative. I think it could be $1,000 per client one day. Again, I have home insurance. My home insurance is almost $1,000 a year, so that's just for home. So if they have the right mix between home and car and pet, I definitely think they could be over $1,000. Let's be conservative. Let's say 750. Maybe we want to say 1,000, but again, this is going to be a huge driver because right now they're only making 250, so you're talking 3 to 4 times more per client. So if you're talking going back again, this is like a basic understanding. You need to grow 30-fold. Let's say your revenues alone are going up 4 times per customer. Then how many customers more do you need? You need about 7.5 to 10 times more customers. Well, right now they have 1.2 customers or 1.2 million. So if they have 1.2 million, you're looking 1.2 times 8 to 10. You're looking at 9 to 12 million customers. How realistic is that? Okay, so again, over the next 10 years, they need to get 9 to 12 million customers. Well, currently the US, and actually this company is more than in the US, they're US as well as Europe, Israel, and they're growing into more countries. The US is, I think, their biggest one. Actually, let's see if they have info on US. Heavily favor the United States, but they're growing elsewhere. Basically, there you go. They're in all 50 states, but they are in other markets. And they want to be an international company. They want to be all over. So this is just US data. So this is, again, on the low end. There's currently 66 million US people between the age of 21 and 35. I'm saying on average, there's about 1.5 people per household. Each person doesn't need in that age group at least. Obviously, like we're not including kids. Um, both people don't need home insurance. Only each home needs home insurance. So if there's 2 people living in the house, then it's divided by 2, but not everyone lives with a partner. And some people have 2 cars, so car insurance. So I'm estimating about 1.5. So that brings it down to 44 million. And every year, about 4 million new people enter this age range. I got these demographic stats online. These are rough numbers, not exact, but again, I like just getting a baseline. So you're talking every year, another 4 million people age into the 21 to 35 demographic, which is their core business. And there's currently about 44 million households in that. Um, so, what percentage of that do they have to capture to get to a total of 9 to 12? So here I have kind of what percentage they have to capture of new people in that new 21 to 35-year-olds versus existing 21 to 35-year-olds. So if you think they can capture 2% of existing and 4% of new in just the States, then in 10 years, they get to 8 million customers. So still below, but again, this is just US. This assumes they get zero from elsewhere, which they're clearly going to do. So again, is this reasonable? Do you think it's reasonable for Lemonade to capture 2% of all new, 2 to 4% of all new people in the age group 21 to 35? I personally think it is realistic. So, you know, these are very small shares. Now, again, this is there's an old quote about, oh, all we need to do is get 1% of the people in China to use our product and we'll be billionaires because there's so many people. Yes, that's true, but one, Lemonade has a very high NPS score. People really do seem to resonate with them. Two, they're competing against non-consumption. So these are not people who already have insurance. They don't have any insurance, and suddenly they need insurance. And so, what are they most likely to go to? An app and someone that speaks their language, or call a broker and speak to someone. I think it's the app. So I think they have the best user experience. I think they're in a growing demographic. I really think they're riding this demographic tailwind. Um, and I think they're going to succeed. Now, I do want to note this company is extremely speculative. I'm not even doing a valuation on it because I find it very hard to model this sort of company. We actually, you know what? We can do a model. However, I do want to just show how volatile this stock has been. So it was priced at, I think it was $40 a share. It shot up to 80, settled down, then went from 50 all the way up to 160. Actually sold a little here at 160. Then it went down to 70, went back up to 100, and now it's back down to 60. So this has had quite a wild ride. And the reason is because so much of this is based on future growth. And small assumptions in our growth estimates, if they get 1.5% or 2% of new people in this age group, the company could be a terrible investment because they really have to grow. They really, really have to grow to get to be a valuable investment. So let's actually do a quick analysis and we'll see what we think. So quick analysis. See, it's tough because what's their revenue? Let's not use revenue. Let's use their, and again, this is in billions, so let's go 0.3, which is 297, which is their in-force premium. So again, I'm assuming they get rid of the reinsurance in the long term, so we're just going to use in-force premium. And their market cap was 3.9. Exit multiple, let's lower it to 15. Which is again is conservative but not too conservative. And let's assume they get 12.5 to 15% margins. Again, insurance company is typically 10. I think they're going to do a little better because of the fact that they're using tech. But to get to this break even, they need 30% growth compounded for the next 10 years. So what does that look like? That looks like revenues going up significantly. Again, part of that is going to be from revenue per customer, which I think is going to 3 to 4x over the next 10 years. So what's if it goes up 3.5 times, let's split the difference. That's going up 13%. So without even any new customers, I think that they're going up 13 this much per year if they got no new customers. So then they need new additional customers to really fuel that growth. So again, you can see they're not getting this. I don't think they're ever going to get this high margin. They could maybe get here, but they're going to need a lot of growth. And it's a very speculative play. And again, every investment's worth it at the right price. But at the end of the day, you still have to predict what's going to happen. I could be completely off. They could grow 60% a year, and this could be a massive investment, or they could grow 25 and it could be a terrible investment. Let's see if they grew 60% a year. You're talking massive growth, or even let's even go 45. Still huge. So again, that's why I can obviously model this, but at the end of the day, it's not really about what these numbers say. It's do you believe they can grow? So we have to take it back to basics. And again, I would not make this a huge part of my portfolio. It's very speculative, but I personally think that I see the insurance industry growing. I see that they have lots of tailwinds, especially demographic. No one likes getting insurance, but if these guys make it a little easier, I think that's a huge plus. And I really believe in the vision of this company and the CEO. I would strongly recommend listening to his name, Daniel Schreiber. Listen to a YouTube video of his. The way he sees the industry, I really think that he's got a great vision for how the industry works. He says, he's not really competing with the big guys. He thinks they can all succeed. And I like companies where you don't have to succeed. You're not going head to head with a Google or Facebook or an Apple. He says, they can succeed and we can succeed. This market's huge and big enough for everyone to do well. And so again, they only want a very small piece of the pie, and I think they could get it. But because the insurance industry is so huge, again, trillions of dollars, that small piece is still very valuable. So, I think that this is an interesting one to watch. Again, full disclosure, I am a shareholder. I think it will do well, but again, I do want to temper expectations. Really, you have to closely watch their growth numbers, because if their growth numbers start tapering off and they start losing traction, the stock could plummet like a rock. But if growth starts to accelerate, either on revenue per customer or just customer total, this could be a huge win. So something to keep in mind. Do you use Lemonade? If you do, I'd love to hear your thoughts on the app, and have you made a claim? Let me know your thoughts on the stock. Are you buying, selling, holding? Let me know in the comment section below. Thanks so much. Again, my name's Josh. This has been Finance Soup, and this has been a not so quick analysis of Lemonade and my thoughts on why you really have to understand the industry you're investing in. So thanks so much, and talk to you next time.